All right, without wasting any time, these are the top 6 high-growth ETFs trading on the US stock market that give you the highest chance of becoming a millionaire without having to pick and choose individual investments. These 6 ETFs are going to be ranked by their level of risk and by their performance over the last 10 years, starting with the lowest risk and then moving our way up to the highest risk, but also the highest potential rewards. So let's jump right in and start with number 6 on the list, which is ticker symbol SPY, an ETF that tracks the US S&P 500 index. Now this is a pretty vanilla choice for high growth ETFs, and that's why it ranks at the bottom of the list in terms of risk but also rewards. But it is still an all equity ETF that makes a concentrated bet on the 500 largest companies in the US, and so for that reason I think it merits inclusion. The price per share of this ETF is around $430, up 16% over the last year. And over the last 10 years, it's yielded an average return of 12.7% per year. Not bad for the bottom of the list because it only goes up from there. Now, SPY is a massive ETF with $400 billion in assets under management. It holds shares in all of the largest companies in the US with a sector breakdown that looks like this. So it's concentrated in tech, healthcare, and financials, but it also has exposure to more or less every major industry that you can imagine. The expense ratio for the SPY ETF is only 0.09%, which is very low. The risk profile of this ETF is medium to high. It's diversified across 500 companies, which decreases the risk, but it's still an all-equity ETF that's solely focused on the US market. All right, next up on the list is ticker symbol VUG, which is the Vanguard Large Cap Growth Index ETF that tracks fast-growing companies in the US, but only ones that have a large market cap, because the median market cap of companies in this ETF is $510 billion. The price per share is around $270, so up about 30% over the last year. And for that, you get exposure to 222 companies across the US that are high growth and that are in pretty much every single industry, from financial to energy to tech and everything in between. If we look at the 10-year performance of this ETF, it's averaging about 13.55% per year, which is very solid returns that is handily outperforming the total stock market. The expense ratio on this ETF is super low at 0.04%, and this is pretty much as low as the fees will get for any ETF. And that's definitely one of the major pros of choosing this investment. However, when it comes to level of risk, this is ranked by Vanguard itself as a 4 out of 5. So pretty high, but not maxed out. It has decent diversification with over 200 companies in the ETF, and it's got solid liquidity and assets under management that total nearly $70 billion. Okay, next up is ticker symbol QQQ, which is an Invesco ETF that tracks the NASDAQ 100 index. And this is an index of the 100 largest and fastest growing companies in the US that are non-financial, so it's a focus on tech sector, but also on innovation in other sectors as well. So no banks or insurance companies in this ETF. It's a more concentrated investment than, for example, the VUG ETF because it only tracks 100 companies as opposed to 222. And the risk and results profile definitely shows that increased concentration. The price per share of this ETF is around $360 today, which is up over 33% over the past 1 year. But over the last 10 years, it has returned an average of 17.5% per year. Of course, there is some volatility in that, and that includes some years where it's up 30%, but also years where it's down 30%, like last year, 2022. The annual expense ratio for this ETF is 0.2%, so 0.16% higher than VUG, but the results are significantly better than the difference you pay in expenses. The top 10 stocks in this ETF include concentrated investments in the biggest companies in America, including Apple at 10.87%, Microsoft at 9.68%, and Amazon at 5.32%, as well as a number of other household names that I'm sure you recognize, like Meta, Google, Tesla, etc. In terms of level of risk, QQQ is a well-established ETF. It's been around since 1999, and it has really high liquidity. It is frequently one of the most traded stocks or ticker symbols on the US stock market. So the risks for this ETF really revolve around the fact that it's highly focused on the US tech sector, which can be boom or bust, as we've seen over the past 5 years. Compared to the total US stock market, it's a high-risk play, but compared to some of the other ETFs that we're about to get to, this is going to seem super safe. All right, next up on the list, coming in at number 3 is ticker symbol IWP, which is the iShares Mid Cap Growth ETF. This ETF invests in small and medium-sized US companies that have high growth potential. And really, you can't have a comprehensive list of high growth ETFs in the US and leave out this part of the market. The share price for this is currently around $90 per share, and for that you're buying fractional ownership in 333 small-ish companies. I say small-ish because the median market cap for companies held in this ETF is still close to $11 billion, which is of course a lot less than the median $510 billion from ticker symbol VUG, but $10 or $11 billion market cap is not exactly tiny company. Now, if we look at the average returns for this ETF over the last 10 years, it actually comes in lower than anything we've looked at so far, at an average of 9.72% per year. But the reason why I'm including it here on the list at number 3 is because the risk profile for this is significantly higher than anything we've looked at so far. With the size of the companies that are held in this ETF, there's going to be a lot more volatility in the share price. It does really well when the economy is roaring or when specific small cap companies do really well, but on the other hand, if there's an economic downturn, then it's really going to suffer. For example, in 2019 and 2020, this ETF returned a crazy 35% in each of those years, but then it turned around and in 2022 went down by 27%. So you really are riding the roller coaster with this type of ETF. The expense ratio here is also a little bit higher at 0.23%. And generally, if you're thinking of including this in your portfolio, I would definitely recommend allocating only a small percentage of your total investment. It's nice to have exposure to this sector of the market, but you don't necessarily want to go all in on this. So we've reached number 2 on the list, and now we're getting to the very, very high risk section of these ETFs, but also the corresponding rewards are significantly higher if you hit it and time it just right. Now this one is ticker symbol TQQQ, which is the 3x leveraged long NASDAQ 100 ETF. It's very similar to QQQ, except that it uses 3x leverage to magnify or amplify the gains. In the past 1 year, this ETF is up over 80%, and over the past 10 years, it's averaged over 34.5% per year in returns. Since the QQQ ETF has been on a tear this year, that means that the 3x leverage long is on an even bigger tear. And like I said, that leverage that it uses magnifies the gains to a ridiculous level, 80% in just 1 year. On the other hand, it also magnifies the potential losses if things go bad. And on the homepage of the ETF website, there's even a big warning sign that tells investors to monitor holdings daily and make sure that they understand the risks. And despite the fact that this ETF has returned very nice yields over specific periods of time, it's not really meant as a buy and hold forever ETF. For example, in 2022, the 1-year performance for this ETF was negative 79%. And over other specific smaller periods of time, the returns on this can be even worse than that. The expense ratio for this is also a lot higher at 0.86% because the ETF managers have to maintain the leverage and do a lot more rebalancing than you might have to do if you just had a simple index tracking fund. Aside from that, definitely handle this ETF with caution and don't YOLO your life savings into it, but it's definitely high risk, high reward. All right, let's round out our list with an ETF that is the absolute pinnacle of degeneracy and maximum risk profile, and that is ticker symbol USD. No, I'm not referring to the US dollar, although the chart on that also looks crazy, but this one is the ProShares Semiconductor ETF. It's pretty much as risky as you can get with an ETF because A, it uses leverage, although it's only 2x as opposed to 3x in the last example, but it's also specifically focused on only one sector, semiconductors. So if the semiconductor industry does well, you potentially stand to make millions, but of course, if it doesn't do well, then game over. Now, it just so happens that over the last 12 months, this sector has done very, very well, and this ETF has returned over 180% gains. And over the last decade, the annual average return has been 36.25%, which is absolutely insane. Whether or not this epic run will continue, though, is definitely another story. Because some of the holdings in this ETF, like Nvidia, for example, have been on an absolute tear over the last couple of years. And if you had invested $100,000 in Nvidia 10 years ago, that would now be worth over $2.2 million. But a lot of people have started to suggest that the semiconductor industry is potentially overvalued now and potentially ripe for a correction. We'll see, but the point here is that you can use growth ETFs that contain leverage to make specific focused bets on industries that you think have potential to outperform over the next couple of years. And if you pick and choose the right ones carefully, then you stand to make a lot of money. Although of course the risk profile with this type of investing is just through the roof. So what do you think? With these 6 high growth ETFs with different risk profiles and different potential returns, which end of the spectrum seems more interesting for you as an investment? Are you more at the SPY end of the spectrum or at the USD end of the spectrum? Let me know down in the comments, and if you like this video, you might also like this one. Thanks so much for watching and have a great day.